Okay, so let's go ahead and get started. Hello, my name is Layla Yoon, and I will be moderating the webinar today. We're so excited to have you here today. And we have three amazing speakers. We have Barry Levinson, he's the CEO of LK Secured Lending, Paul Kessler, Chairman of LK Secured Lending, and Karen Hall, CEO of UDirect IRA Services. And the chat option will be open to everyone, so you can send the chat to everyone while the speakers are presenting. Today's webinar will be consisted of 45 minutes of speakers talking about alternative assets and investments, and 15 minutes of Q&A panel. But feel free to chat, use the chat option to ask any questions at any time. So I'll give the mic to Barry.
Thanks, everybody. Actually, I think see if I can move forward here on this. Thanks, everybody, for joining us today, and Happy New Year to everybody. This should be a fun, good conversation. I think Paul's going to kick it off, and I will jump in a little bit. So it's all yours, Paul.
Fantastic. Thank you, everyone, for joining. I think today we find ourselves in a very unique and interesting investment environment. We have quantitative easing that started a couple of years ago. It hasn't stopped. Obviously, with the advent of COVID, it continued. We have investors who are very concerned about a bubble potentially in the stock market and whether or not this is the right time to buy, the right time to sell. At the same time, there's investors like myself who are looking for yield, but yield that would come with safety. And I kind of feel where we are in this cycle is, even with the various factors that are occurring and the potential for inflation, being a lender to income producing property is probably one of the better places to be, where we're not at risk with our equity dollars in an overinflated stock market, while at the same time we can sleep at night generating yield from properly placed investments in real estate income producing property. If you look at the amount of rate of return your money will earn in various instruments that are offered by traditional banks, savings and loans, and other institutions, as seen on the screen, CD rates today are extremely nominal. Anything from 0.05% to, you can see the scale from 3 months, 6 months to a year. It's negative inflation. So if you leave your money in a bank with inflation at even 2 to 3%, you can see your money is being marginalized, your cash is being marginalized. And is it really the best place for cash? I would say no. CD rates certainly are not a good option. If you then move on and you look at other forms of money market instruments aside from CD, look at the rates. Again, very, very small. And again, if you're locking your money up long term, yes, you'll get incrementally better. But again, it's incrementally a false economy, because after you factor in inflation, you're negative inflation, you're actually losing money. And again, you can see the various institutions and what they offer. And from Navy Federal Credit all the way to BMO Harris, it's not very appealing. I always remind myself of when my parents and my grandparents and my aunts and uncles all worked really, really hard throughout many years, only to get to a retirement age and believe that their savings would have a rate of return. Unfortunately, that's simply not the case today. So we've looked at two elements. Now we look at bond rates. Again, different risk profile, but you're not really being offered much. So in every instance, we're seeing rates on average that are under 1%, but really it's somewhere between 0 and 0.5%. And that's for tying your money up. We feel at LK Secured Lending, you're far better off investing in real estate vis-a-vis loans, where you have a factor of protection by very solid conservative underwriting. And we can go to another slide, which is the S&P index, and it's going to show you phenomenal performance. But the question is, how long will that performance be with us? and what's our risk tolerance. I can tell you, for me, I turned 60 years old last year, and I spent 30 years on Wall Street as a venture capitalist and a capital markets professional. And a few years ago, started making and graduating to the lending environment with secured real estate loans. And I sleep much better at night. And I feel, for where I am in the life cycle of business and life in general, this is a much better place to be. I also feel that with the uncertainty in the market today, with inflation where it's at, I'm much more comfortable owning assets that, even with inflation, should perform just fine. That's real estate income producing property. So in conclusion, with inflation historically 2 to 3%, we'll call it 3%. If you're investing in money markets, bonds, CDs, things of that nature, it's likely to be economically not very favorably or favorable, but more importantly, you're probably losing money. And the stock market, of course, at an all-time high. Yes, there's a pandemic. Yes, you have quantitative easing that continued as a result of it. But sooner or later, you know, the tire has to hit the road and things will change. Our view is be defensive, be smart. And for our capital, we're putting quite a bit of it to work in loans secured by income producing property, which again, we believe will perform just fine, even with inflation. Thank you very much. Barry?
Thanks, Paul. So Paul mentioned that he comes from Wall Street. I actually grew up in banking, and most recently, I had a real estate acquisition fund for several years, which I was CEO of. And like all real estate funds, all REITs that are acquisition funds, the risk is really on the investor. And what I mean by this is, and you can see by the slide, if there is, say, a $15 million property, say a small apartment building, and it's got a $10 million loan and $5 million of equity, the down payment, and that property goes down in value to, let's just say, 10 million. Well, what happens? Well, the bank gets all their money out, 100%, and the investors lose all their money. That's not very good. So a couple of years ago, I said I wanted to start a much safer fund. And I was actually talking to a banker about this. I said, I really want to create a safe fund because I think real estate is overpriced. And that banker introduced me to Paul, who was saying the exact same thing coming from Wall Street. So in our fund, we've really changed it. So here, we are the bank. You are the bank. The investors in the fund are the bank. So now, using that same example, if there's a $15 million property and we do a loan on it of, say, 10 million, and that property goes down in value to, let's just say, from 15 million to 10 million, our investors come out 100% whole. In this case, it's the borrower that loses money. So in our fund, we've really shifted the risk from investors, which is the case in almost all real estate funds, which are acquisition funds, to the investor. And that's critical. And that's why we set up the fund the way we set it up. Now, because we're doing short-term bridge loans, we're still able to pay a really great return, even with all this safety. And there's a whole host of reasons why we get these loans. There may be somebody looking for a Fannie or Freddie loan, and their apartment building or whatever their property is, maybe it's, say, 85% occupancy, but the market's at 90% occupancy. Well, Fannie or Freddie is going to say to them, hey, go get a one-year loan from LK, secured lending, get it up to that market occupancy at 90%, and then come back to us. Or they're $100 a unit under market rent. Same thing, Fannie or Freddie will say, go get it up to market rent, and then come back to us. Or they just want to close quickly. Or, and for those of you that aren't familiar, all the Fannie and Freddie loans out there, which is 95% of all commercial loans, have what's called defeasance. So if you're going to sell the property soon, if you're going to refinance soon, you get hit with huge fees. And a lot of folks, a lot of borrowers just have a short-term horizon and they don't want to deal with that big penalty, that big defeasance. So it's another reason they come to us. They may be, ready to sell, but they're at 90, 95% finished, and they just need a loan for a year to get it finished and to sell it, or that kind of thing. So what we've done in this fund is we've really shifted all the risk, or almost all the risk, from the investors, which is the case in all the traditional real estate funds and REITs, to the borrower. I'm going to give a few examples of some loans that we've done in the fund. So here's one that we did in San Jose. This is a bridge loan. Again, these are these loans that are about 1 year in length. And this was until the borrower secured a large construction loan to build 3 towers to the maximum density and height. Now, in this case, this borrower is the second largest owner of properties in San Jose after Google, and signed a personal guarantee, by the way. The property was purchased for $22.5 million for these 6 properties. And the borrower's net worth, as I mentioned, is over 100 million. So here, they just needed a little bit as a short term until they did this big construction loan. So we did a loan for $3.5 million, which is a 65% CLTV of purchase price, for the loans. The borrower had already put $8.25 million down. It's a 12-month loan. A minimum interest to LK is 6 months. I mentioned a personal guarantee, and this had an interest rate of 10.9. So what he'll do is he will refi out of our loan at some point, probably in a couple of months, into a big construction loan or a Fannie and Freddie loan with them. Here's another one that we did recently. This was Vernon Studios on Fruitland Avenue in Vernon, California. Here they were just looking for a little bit of working capital. Property value is around 39 million, based on a third-party appraisal, which we always get third-party appraisals on all of our properties. The borrower in this case had a personal financial statement, a net worth of over 200 million. She had recently become a widow and was just looking for a little bit of cash, very, very real estate heavy. So here we did a loan of $3 million. The combined loan to value is 39% of the appraised value. 12-month term, interest rate 10.9. And this was sent to us from a bank that asked us to do a short-term loan while she's working on a couple of things with some of her other properties. Here's a high-end residential home in Newport. As you can see by the pictures, extremely beautiful. Here, the borrower, this is a business purpose loan. He wanted to invest in his friend's business. The property was purchased in April of 2020 for 20.6 million. And pretty new, built in 2017, and again, a personal guarantee. So we did a loan for $3 million, 12 months, 10.9%. And obviously, again, on all of these properties, there's a ton of equity in the properties. Our fund right now has a loan to value, an average loan to value of 48% for all the properties, which is phenomenally safe. Another one we did recently was a warehouse / industrial building that sold water skis and jet skis and boats. And she wanted to have some working capital to continue business operations. We received a third-party MAI appraisal for $12 million. It was 100% occupied by Mission Sports. Here it was a smaller loan, just a little bit over $1 million. 12-month loan, 10.9%. And she sold the property recently and cashed us out. Another residential property, and hopefully these are giving you a really good feel of the kinds of loans that we do. Here they were 97, 98% finished on construction. The list price is $26 million. The developer had already put $22.5 million of their own money into it and just wanted a little bit of money just to finish it up and get it sold. As I mentioned, it's not for sale, and they've turned down a couple offers of 24 million. So again, it's a 12-month loan. They didn't want to get involved with those Fannie or Freddie or a bank and have prepayment penalties and all the paperwork and problems that go with that. They just wanted a quick, easy loan to get the property sold. And because of all the equity, again, we were happy to provide that. Um, there's a lot of samples we can give of loans we've done. I think here's a really small one, and we're happy to do small ones too. This one again was for sale. The owner was looking for a little bit of money just to until the property got sold. We did one for 315,000 here, very low loan to value, 10.9%. This one got paid off a few months later. So you can see the kinds of loans we're doing, whether it's residential or it's a warehouse, or it's, in this case, it was a movie studio and it's being reconfigured. And these were medical buildings that's being reconfigured. So usually it's somebody that has a very good balance sheet, a lot of experience in what they do. We do low loan to value ratios, really keeping it always to 60% or less. We are trying to stick in just the areas that have such strong demand. So we really haven't done any retail or office, pure office that's staying as office. We're really trying to stick to where the demand exceeds supply. So my hope is that gave you a good feel for the kinds of loans we do. And I'm going to give it back to you, Leila, to continue.
Thank you. So that is everything from LK Secured Lending. Now, Ms. Hall is going to present about self-directed IRAs.
Karen, you're on mute. There you go.
Awesome. Okay, here we go. Let's just share that screen. Thank you so much. Beautiful buildings there, just gorgeous. All right, so slideshow and from the beginning. Okay, thanks so much for inviting me to join you on the webinar here today. My name is Karen, and the company is UDirect IRA Services. And so what we help you do is take your retirement account, like your 401k from your old employer or an IRA, and take that money and invest it outside of Wall Street into assets like private debt, real estate, precious metals, so many different things. You know, you can buy performing and non-performing debt even, just lots of different alternative assets. So what we do is we are administrators, and we administrate, helping you get from where your funds are now into a deal. But what we're not is we're not advisors. So we don't tell you what to invest in. We don't endorse any particular investment. It's called UDirect for that very reason, because you are directing us, and you're the one driving the bus. It's your IRA, you're choosing your asset, and we're doing the administration of moving your money from where it is into that asset. 100% of your proceeds go back in the IRA that owns the asset, and any expenses of the asset are paid for by the IRA. So what I'm going to do here is kind of hash out the rules shortly and quickly so that you understand how self-directed IRA works, and very happy to take any questions at the end. Obviously, an IRA, it's all about saving for retirement, an individual retirement account, or a solo 401k. We also provide those. That is a 401k for someone who's self-employed who has no full-time employees in any of the companies that they own. But there's a huge, huge deficit between what Americans have and what we need to retire. And so the self-directed IRA, you know, like Paul was explaining, you know, when you put your money in a bank CD, you're getting such a little return. So many people like to look at the alternative asset space to have a larger return and grow their retirement assets even more quickly. So what's so interesting about self-directed IRAs is not only is it a good place, you know, a good way to invest your retirement money, but if you're raising capital, well, it's also a good source. If I updated this slide, it would be more like $31 trillion in retirement accounts today, not just the IRA, but the 401k, defined benefit plans, all these different kinds of retirement accounts. And so many people don't know that they can take their retirement account and move it into a self-directed plan that can then invest outside of Wall Street. Now, if you haven't heard about self-directed IRAs or this self-directed concept, you're not alone, even though the concept is something, it's over 45 years old. You know, it was when Gerald Ford was president that these laws went into effect. The ERISA laws went into effect in 1975. So what is that, going on 46 years? So still, a lot of CPAs, a lot of attorneys don't even know about this. A lot of investors don't even know about it. We call it the best kept secret, right? And that's why. So it's something you can do, and there's a lot of track record to this. It's certainly nothing new. Now here we are at the beginning of the year, and a lot of people are thinking about lowering their taxes. So this is also the time to think about contributing to an account. In most accounts, you can make a prior year contribution. In fact, most all accounts. In fact, they just changed the SOLA 401k, where if you open a SOLA 401k today in 2021, now, it didn't used to ever be the case, but now you can open a SOLA 401k today and still make a 2020 contribution into that plan. Now, these are things to discuss with your tax advisor. Is your contribution tax deductible? How much can you contribute? And how does this factor into your overall tax planning? So that's a great question to have, when you're talking to your tax advisor. So we talk about a self-directed IRA, and there are a lot of misunderstandings. I'd like to clear them up. So a typical IRA, you might have like a TD Ameritrade or Charles Schwab or somewhere, either at your bank. A typical IRA lets you invest in stocks, bonds, and mutual funds, maybe a CD. But a self-directed IRA just blows the doors open on that, and now you can invest in alternative assets. And again, I list some of them here. Private stock, Reg D offerings, LLCs, tax liens, even just all these different kinds of asset classes. Our account holders are investing in all of these different asset classes. So what are the limits? Well, the limits were set by the IRS when they first created the IRA in 1975. And the IRS said you can invest in anything except life insurance contracts and collectibles. All right. So, wow, that leaves a lot, right? It does. But, the IRS is pretty smart in the way they did this, and you'll learn more as we go forward. Now, there are things that the IRS says you can do, but an IRA custodian can also say what they find to be administratively feasible. So in other words, an IRA custodian can make a business decision that, no, that's not an asset we're going to have our clients invest in, for example, or that we're not going to custody that asset, I should say, like racehorses. A racehorse is an asset. It's certainly an alternative asset. Some self-directed IRA providers will let you put racehorses into your IRA. I mean, obviously not physically, right? But with us, it's an asset class that we choose not to custody. So we call it not administratively feasible. No conversation about self-directed IRAs is complete without at least a quick rundown of the rules, because self-directed IRA investing isn't like just investing your own cash. And so you have to kind of put this in a little bubble of its own. You've got this little world where the rules are different, okay? And you can read about some of those rules on the IRS's website, irs.gov. And in publication 590, there's 590A and 590B, kind of lays out what these rules are. With IRAs in general, you don't borrow from them personally. You can borrow from 401k, but not an IRA, all right? You don't sell any property to it that you personally own. It's not security for a loan, and you just don't use it to buy assets for personal use. Now, here's what's really different about self-directed IRAs. If you're going to play a game of self-directed IRAs, there are people that can't play with you. They can't play the game, and those are disqualified people. They're your ascendants and descendants. So it's your parents and grandparents and their spouses, you and your spouse, and your children and grandchildren and their spouses. So I'm going to explain this as we go forward. They're disqualified, plus any 50-50 business partner or anyone who is a fiduciary to the plan. All right. Qualified people, those are the people who are out to the sides on your family tree, like your aunts and uncles, your cousins, brothers and sisters, nieces and nephews. They're okay. Like your next door neighbor, that's fine. Your dad, not so much. And we'll explain. Okay. So, and actually, let's just go back a little bit. Maybe I'll need to flesh this out a little bit. This is to say, like as an example, did you have a question, Barry? No? Okay, so with, with allowed and disallowed people, the example would be if say, for example, your IRA bought a house. Now, you would never live in it. Your parents, grandparents, your kids, your grandkids could never live in it, never even stay in it for one day. And so it's just really important to understand what the rules are before you go ahead. And that's what we're here to help you with at UDirect, to talk to you on the phone for a while. Let's hear about your investment, who are the parties, and have that conversation with you. So when you talk about the kinds of plans that are self-directed, we call it the self-directed IRA, but it's this umbrella of different kinds of plans: traditional, Roth, SEP, simple, spousal, inherited, also the solo 401k that we provide, but also other plans like a Coverdell or an HSA. All of these can be self-directed. And how do you do it? I mean, how do you self-direct? It's not that tough. If you've got an IRA or a 401k with a previous company, you open an account. That's step one. Step two is you fund the account by moving the money into it, either by rollover, transfer, or contribution. And once the account is open and funded, you can invest. 100% of the proceeds from those assets must come back into the IRA that owns the assets. And if those assets have expenses, then 100% of those expenses have to be paid for by the self-directed IRA that owns it. That's how it is: open, fund, invest. And if you'd like more information, we're going to have Q&A right now, and Layla's going to walk us through that. But this is how you get a hold of me. Just info@udirectira.com is the best way. And then I'm happy to answer whatever question that you may have. So with that, I will stop sharing and send it back to Layla and let her take over and take your questions.
Thank you so much.
Yeah.
So thank you all the speakers for such an insightful presentation. And if you have any questions, please submit them in the chat. Meanwhile, I will be asking some questions
I'll
as
kick
well.
it off a little bit,
So,
if you don't mind. One of the
go
reasons
ahead.
that I thought it made sense to do this webinar together is a lot of our investors ask about investing through their IRA or their 401k. And what happens is that the big IRA companies, the big 401ks, can't make any money off of our fund. We don't pay them a management fee or a commission like most of the real big investments do. So what we say is, yeah, absolutely, you can use your IRA or your 401k, but you need to do it through a self-directed, which allows you to put your money, as was just explained to you, into any type of investment. But that way we don't have to pay those 10% commissions to the Schwabs and the TD Ameritrades, which we feel is just exorbitant. We pass on almost all the interest from the loans to the investors. We don't have the margins to pay those huge fees from the big houses, the big brokerage houses. So we really like to keep the IRA investors, the 401k investors, from these self-directed plans. It just works a lot better. Sorry, Layla, I'll give it back to you.
Oh, no, not at all. You actually answered my first question. I was going to ask, is there anything we were leaving out that needs to be addressed? So if any other speakers have any piece of advice or anything they want to address.
I think I'll add something to Barry's point. With self-directed IRAs, like how do we earn money? We don't get a percentage of your asset. It's not like that at all. It's really great for the account holder because we're not paid on the assets under management like this. We get account fees. And so when you take a look sometimes at the IRA or the 401k you have at one of these big warehouse brokerages, they're taking commission from places that you might not see. You might not be getting all the return on the assets that you really expect you're seeing. And so there are no hidden fees. We disclose everything up front. It's an annual setup fee, pretty straightforward. And so anyway, so that's how it happens. It's not like, Barry would never pay us a fee. It doesn't work like that. It's client fees for the accounts.
Right.
Thank you for that. So another question that I have is, what is the best resource for people who want to dive in deeper? Of course, they should definitely schedule calls at any of you guys if they want to learn more about it, but are there any other resources that they can look into?
Well, for LK secured lending, our website has a lot of details. We also have various marketing materials that can be sent out. Nice summary of our private placement memorandum. We're also happy to send out the private placement memorandum, which is 87 pages, single spaced. But really anybody who's interested should take a look at the materials, should have a call with one of the folks at LK, should read the PPM at some point, but happy to take a call with anybody that has questions, or anyone here will do the same.
So if anyone has any other questions, please feel free to just speak up or put them in the chat. But meanwhile, I have one more question. What's the question you are most hearing about the subject, and what would you like to say about it?
I can jump on that one. Right now, everybody's interested in Bitcoins. And so, it's a big deal. And it's another asset class. So a couple of things to keep in mind. Of course, I'm conservative in this because I'm talking about people's retirement money. It's something to really be conservative about, but you can do it with a self-directed IRA. You would use a vehicle called an IRA-owned LLC, and we're going to get a little deep in the weeds, but you would use something like that. But I'd also point out that the SEC came out with some guidelines cautioning people who are going to use their retirement money to invest in Bitcoin. That's on our website, because a lot of these initial coin offerings can sometimes be shady. Some of these asset sponsors are bad actors. So you just want to really do your due diligence anytime you invest. And Bitcoin is especially, one of those times. I'm using Bitcoin, and I really mean cryptocurrency as a general term. Is it an asset you can put in an IRA? Yes. How do you get it there? That's a different story. So we can talk about that.
The question I get asked the most is, where's real estate going? And I'm on the board of the Ziman Center at UCLA. We have the professors and PhDs present to us every month. And what I would really say on that one is it really depends on the sector. Everything is supply and demand, everything. And if you look right now, retail supply exceeds demand. And due to this pandemic, office supply exceeds demand. So those sectors are really soft. But the demand for residential, whether it's multifamily apartments, whether it's single family, for medical, for senior housing, for warehouse, for a lot of these other areas, is still way in excess of supply. So, when you look at our fund as being a safety play, the questions that come is exactly how. Well, if we're at a 58% loan to value for the fund, that would mean that our properties, which remember are not these retail and not these office, would have to go down over 52%. And if that happens, we're probably have much bigger problems. We're probably in World War III or something along those lines. So that's how we've structured this for safety, is by really sticking to the sectors where demand way outstrips supply. That's really what it comes down to, is which sectors are oversupplied and which sectors are undersupplied.
So we actually have a question from one of the audience members. It's short and simple. How do I invest?
Oh, good question. Well, in the case of LK secured lending, you need to read some of our materials first, which is very short and very simple. So I can have anyone in the company send it to you. I'm happy to as well. Leila, you can, but there are some materials that you should look over. And then it's very easy, whether it's through a self-directed IRA, some of our investors do, or directly from any account. And then what we're doing right now, which is really very special, is the day that you invest, you're starting to earn that very high rate. While the private placement memorandum that's filed with the Securities and Exchange Commission says you have to wait until the next loan is funded, we've actually structured it now so there is no wait time, and you're immediately put in the fund, which is, as you know, targeted at 10%. And that's paid, of course, every single month if you choose to get a check, or some of our investors have chosen to reinvest, and then you get, the compounded interest instead of a simple interest. So maybe I can put my email into the chat, or Layla, you can put yours, and people can just reach out to us that are interested in the next step in investing. Oh, you're on mute.
I'm
Layla.
muted. For next steps, you can definitely visit our websites. I will send both websites in the chat. And for any of the questions, please contact any of us and we can discuss anything from investment to self-directed IRAs. Any other questions from the website? Oh, we have one. What is the impact of COVID on this fund?
That's a good question too. And it's interesting, it kind of relates to what I was saying earlier. One of the things that the Fed has been doing is keeping interest rates extraordinarily low. I'm not talking 20-year low, I'm talking 100-year low. So what that's done is it's given everybody much more affordability to buy properties. So it's really kept the property values high. And what the Fed has indicated is that they're going to keep these low rates for at least 3 years. So in some ways, the pandemic has forced, I'll use that word, forced the government to lower the interest rates down to practically zero. That's what they loan to the big banks. And then the big banks, of course, mark it up a little bit and loan to everyone else. So by doing that, it's actually kept property values pretty high. Across the board on, again, those areas where demand exceeds supply. I don't think anything really could have helped retail. But with the exception of retail, the interest rates have really kept prices very high. And according to the Fed, they're going to be doing the almost zero interest rates for at least 3 more years. So I don't know, Paul, do you want to add to that?
I would say that the majority of the folks that borrow money from us are professional sponsors and very expert in real estate. They normally have very large portfolios, and they're also looking for very short-term money, 1 year, maximum 2. So with the Fed's outlook, we are very well positioned. We continue to be well positioned, and the demand for our type of short-term, we'll call it maybe in some instances bridge capital, is fantastic for those types of real estate professionals and sponsors. So it's been a very good time for us, and we continue to see that that outlook will very unlikely change, especially as we remain conservative in our loan to value and the way we price our loans.
See, what Paul's getting at too is our fund doesn't really have interest rate risk that all the some funds have, because when you do the longer term loans, and this includes Fannie and Freddie, if you're doing a 30-year loan or a 15-year loan, well, if interest rates start to rise and you've locked in a 15 or 30-year loan at a much lower rate, that's a problem. That's called interest rate risk. What we do by only having 1-year loans is we've eliminated that. So our loans keep turning. And if 3 years from now, 4 years from now, the interest rate environment is higher, well, we'll adjust accordingly. But we really have removed that interest rate risk by only doing these, what we call bridge or short-term loans.
Thank you for answering all the questions. If the audience has any other questions, please ask them. You can chat me privately or message everyone. Oh, okay. So we have another question here. How are you protecting my capital?
So again, these properties have a substantial equity. So say that somebody is buying an apartment building, and as I mentioned earlier, one of the cases they may come to us is that their value is there, the third-party appraisal is there, but they may be a little bit under market in terms of occupancy, say. Well, we're doing a short-term loan, which I mentioned is called a bridge loan, for this year while they get that occupancy up or while they get that market rent up. And then they're going to move to that Fannie or Freddie loan for that long-term loan at a lower interest rate. But what we're doing with this is we're doing a very low loan to value. So most of the equity again is from the borrower. If you remember my original example, in most acquisition, almost all, or all acquisition funds, the borrower is the equity, excuse me, the investor is the equity. So in that example, the $15 million property with 5 million of equity, that's the investor. And if that property goes down in value, those investors lose money. In our fund, we're the bank. So if that property goes down in value, the borrower loses money, our investors come out whole. So if you do it that structure, which is a safety structure, and then you keep your loan to values low, which we do, then that's about as safe as it gets in terms of a very low loan to value and positioning our investors as the bank versus being the equity or junior to the bank loans. We are the bank loans. I hope that answered the question.
Yes. And somebody also asked if the questions and the whole meeting will be recorded, and it will be recorded. So does anyone else have any questions before we wrap up? Any last comments that the speakers want to make?
Pleasure doing this. We'll continue to do informative webinars. We've gotten a lot of requests for them, so we will continue to do it. We want everyone to completely understand and be educated, and that's the goal of these webinars. So thank you, everybody, for attending, and please feel free to reach out to me, Paul, or anyone from the OK team.
Please visit both websites. I'm linking both websites in the chat right now, so feel free to open them and check it out to find out more information about it. Last call for questions, and if not, we can wrap up the meeting.
Thanks, Leila.
Of
Stay
course.
safe, everybody. Happy New Year.
Happy New Year, everyone.
Happy New Year.
Hopefully-
Thank you.
Thank you.
Thank you, everyone, for coming.